you have a product or you're a service business, whether you're asset intensive or whether you're asset light, cash flow is always going to be king. And what needs to be there for potential investors is a compelling growth story, and that's got to be qualitatively and quantitatively hashed out. If you can do a forecast that is a bottoms up and top down approach and very pragmatic, and you can kind of prove out that story in a quantitative fashion, that's great. But it's also good to have that qualitative story in terms of the growth story for your business. And most companies transact based on a multiple of earnings before interest, taxes, depreciation, amortization, or EBITDA. And that's a proxy for cash flow. You will have some companies that will transact on a multiple of revenue, but typically that's at the startup phase, or companies that have potentially run into issues where they're not cash flowing under a normalized expectation. But the expectation is that you will scale quickly and eventually achieve those desired margins. And then revenue growth and the ability to expand margins are the keys to improving cash flow. So obviously, if you can reduce your costs, increase your revenue, expand those margins, improve your cash flow overall, looking at things like working capital requirements, anything to improve that cash flow improves value. Any questions there?
So far, none.
Okay. So how do you value business? So there's three typical approaches: the income approach, the market approach, and the asset approach. And let's talk about the income approach first, because that derives the intrinsic value of the business. All the inputs and assumptions around an income approach are very company specific. There's the discounted cash flow method, which will look at the future economic benefits accruing to the business, and you present value those to a current date. So that's generally used for a growing business where you haven't achieved normalized growth and normalized margins. You're still in that growth phase. Your margins may be expanding over time. Your top line's expanding, and you can forecast at least out to a full business cycle, 5 to 7 years, and you present value those cash flows to achieve the value of the business, or an indication of value for the business. And then there's the cap of earnings method. That's for more mature businesses that have kind of, hit that normalized growth rate, hit normalized margins, and you can take maybe the previous year's earnings and apply a cap rate to it. And when I say a cap rate, it's a discount rate. And that's generally market-based, but also considers the capital structure of the business itself. And then there's the market approach. I view this almost like real estate. So there's guideline transaction multiples, where you look out to the market and look at closed deals within your space and look at the multiples of either EBITDA or revenue that those companies are transacting at. And then for larger businesses, you can look at guideline public company multiples. So publicly traded stock of a company that's reasonably similar to yours, you can get trading multiples for those companies and then apply that to the financial metric of your business. So whether it's price to earnings, enterprise value to EBITDA, enterprise value to EBIT, or enterprise value to revenue, you look at all those multiples of those publicly traded companies and then apply that to the same financial metric of your company to get an idea of what your business is worth. And I kind of look at the market approach is a lot like if you're selling your house, right? You're going to want to know what houses in your neighborhood or general area are selling at on, for example, a per square foot basis. So, if your neighbors are selling at $250 a square foot, when you go to sell your house, your real estate agent is going to look at those multiples and apply a similar metric when they price your house for sale. And then there's the asset approach. This is the net asset value. This is typically not used for companies with a going concern. They're typically used to value asset holding companies. So I would view that as a floor value. Sometimes you'll see it used where the company is in decline and the value of the net asset value of the business is worth more than the expected cash flows from the business. So any questions on
Zain,
how to value a business?
Zain, for that last one, are you able to just provide an example?
Yeah, it's literally looking at the balance sheet, right? So you have your assets, you have your liabilities, and you have your net amount, which is typically your shareholder equity, right? But in this instance, you would fair market value the assets and the liabilities to come up with that net asset value. So if you're an asset intensive business with a lot of machinery and equipment, that may not be the same as book value. You may get a lower value depending on the quality of the assets and the demand for those assets, or a higher value. And then same thing with your liabilities. If you have a lot of bank debt, does it need to be taken out on a notional basis, or potentially could that debt be worth less or renegotiated at some better term? So it's a process of going through that balance sheet and saying, okay, I know what my book value is or tax value is, but I need to know what my fair market value is of those assets and liabilities.
Perfect. We do have a specific question if there's time now.
Sure.
Yep. So one of the questions that I see is there are a number of women who have service-based businesses, and as they think about what an asset is for them, some of the considerations they're asking is, hey, I've built some kind of proprietary assessment. Do I value that? B, right? I have a distribution list of 3,500 people. Do I value that? Can you talk specifically on what is an asset when it comes to service-based businesses?
Yeah, for service-based businesses, there may be a lot of intangible assets that have value, right? Your intellectual property, whether that's technology or some marketing-based intellectual property that may have value. Your brand may have value. Obviously, your customers have value, right? And there could be a multitude of other intangible assets, but all of that should be considered in a service or asset-like business. And going back to it, all of that value is again predicated on the cash flows of your business. And we can get into that into the next slide, but
perfect.
Typically, when you're going to sell a business or you're looking for new investors, you're not getting as granular as the individual intangible assets or the IP. You're looking at the business overall and what that IP contributes to the business in terms of cash flows. Will it be able to generate cash flows for a sustainable period of time? Is it defensible from a legal standpoint? Do you have patents? Do you have copyrights? Do you have other barriers to entry that will help sustain your business's revenues and margins?
Wonderful. Thank you.
So I think we're going to kind of get into that, right? So what are other areas important to investors? The number one thing we hear from whether it's private equity or venture capital is that they're looking at the quality of management, because that's what they're really investing in, is the people that are running the business. Especially financial buyers, they're not looking to take over the day-to-day management of the business. They're more passive in their investments, versus like strategic buyers where one company buys another company and you may see that layer of management replaced by the buyer's management. So things that they're looking for. Do you have clear and defined objectives in your business plan, and are you the right team to execute on those objectives? Do you have the people in place to execute on your business plan? And then, are you aligned with them in terms of the direction of the company and the vision for the company? What they're going to want to understand especially from entrepreneurs, is your previous successes and failures, and what you've learned from those successes and failures. And sometimes it's the failures that are more important, right? What you've learned from those failures that matter most. There's also the trust factor. Are you, either as an individual or a team, going to always act in the best interest of the business and its shareholders? And then finally, this we see from a lot of private equity companies, that are looking to help maybe turn around a business, is, are you coachable? Are you willing to accept counsel in areas where you may be deficient or lacking experience? That's where private equity can be very helpful to a business, because they've invested in all types of businesses, and typically they have an industry vertical that they're specifically investing into, and they may have a lot of people that have a lot of experience within that industry, assisting them, where they can provide counsel to you in areas where you may be deficient, whether it's the business operations, or kind of entering a new market, whatever it may be. They want to know that you're going to be willing to accept that coaching. So any questions there?
We do have some questions that came up in the chat. One of the questions was, what is the value of your trademark? Is that something you can use? And then, is there a value in B2B partnerships or licenses? Can that be counted towards assets as well for valuation?
Yeah, I mean, so you can value a trademark one of two ways. Like, if you're actually licensing out that trademark, you're getting revenue in terms of a licensing agreement, and you look at the agreements you may have in place. You may have more than one, and again, you can forecast that out and bring it back to present value to kind of get an indication of value for the overall trademark. I mean, you think about companies like Nike and Apple. I mean, yeah, they make things, but for the most part, they're brand companies. All their value is in their brand. Same thing with even a more mature business like Coca-Cola, for example. I mean, everything lies in that brand. They'll tell you it's in the formula, but at this point, it's really the brand. And then your second question was around licensing.
I think it was around partnerships too. It was, so beyond the trademark, hey, if I've put in the work this year to get maybe corporate partners or nationwide partners, is there value in those established relationships?
Yeah, as long as there's a revenue stream that's identifiable, that's attributable to that intangible asset, whatever it may be, you can value that separately, for sure.
Wonderful. Thank you.
And that's a space where I probably spend, I would say 60% of my time is looking at those individual assets and ascribing value to them. But they're just components of the overall value of the business. So what other areas are important to investors? Really, the addressable market for your goods and services. Is it expansive? Is it a large market? Or is it niche, right? Typically, if your addressable market, the larger your addressable market, the more value there is to your company, as long as you're getting or increasing market share within that addressable market. So that's the second thing that they look at, is how difficult is it to attain or retain market share? Do you have certain competitive advantages? Like you said, do you have a a technology that's disruptive to the industry? Do you have a brand that's just gaining strength and has a large following? Those type of things that they're looking for that provide you a competitive advantage within the industry so that you can at least attain or retain market share. And then are there tangential markets that you can eventually expand into? You may be niche, at the beginning, but you're developing new products or new services or expanding kind of your portfolio of products and services where you can expand into a tangential market. And really that goes back to that growth story. Can you expand that growth runway? Because the longer you can achieve outsized growth for your business, the more valuable it is. I mean, we think about companies like NVIDIA, right, in the AI space. I mean, their market is huge because it can go across industries, across sectors. Everybody's investing in AI right now. And then is there elasticity to your goods and services with respect to demand, right? The more inelastic your goods and services are to your end buyers, the better, right? Because they can't live without it. Or, there's a certain price to which they will, not live without it, for example. I hate to use it, but if you go back 30 years, the cigarette industry was viewed as very inelastic, right? Because smokers were addicted, so they were willing to pay higher and higher prices for tobacco, regardless of what was going on from a regulatory standpoint. And then is there a high percentage of recurring revenue in your business? And that may be tied, that goes to customer loyalty in a sense, but that inelasticity as well. Are you seeing repeat customers? Is there some kind of brand loyalty or customer loyalty that you've built up in your business? Because the more recurring revenue that way, that takes some of the risk out of the business from an investor standpoint, because they know they're going to see those revenues year after year. I think, probably 5 years ago, the subscription model was the hot thing in terms of private equity investors, right? They were investing in a lot of these yoga studios or fitness gyms where it was subscription based. You're paying a monthly fee every month, and I think they love those because people would forget to cancel their gym memberships and not even use them. But that's a lot of what they're looking for.
I wanted to come off of mute and video. Good morning. The yesterday session was helpful. This is very impactful as well. And I just wanted to ask, I have a service-based business, compensation consulting, based on employee pay. And, I'm very new. So I just launched my business 4 months ago. So how do I value or set myself up, for success when I get paying clients to increase my valuation?
Yeah, I mean, for you, it's going to be expanding that client base, right? Or penetrating your existing client base further than you currently are. There are other services that you can provide that existing client base, and then it's expanding the client base at that point. Whether it's through word of mouth referrals, going to industry fairs where you're meeting more people, networking, anything you can do to increase that client base is obviously going to enhance the value of your business.
Okay, and I have a follow-up question. So based on, the services that I offer, I have over 30 years of experience in this area. Would, the experience, my depth of experience,
100%. I mean, that's
Okay.
what I was saying. The number one thing investors or potential buyers of the business look at is the track record of management and their experience. And,
Okay.
hey, you have a business plan, you're executing on that business plan. We want to partner with you. Maybe you just have a need for additional capital to do things like expanding your client base, do more marketing, for example.
Okay.
Look, I'm not cash flowing enough to kind of have that pool of money right now, but if you invest and maybe take a minority interest in my business, the dividends back to you will give you an outsized return, for example.
Okay. All right. Thank you.
Awesome. Were there more questions? Did we get to everyone's question? I just want to make sure that everyone feels seen and heard. Awesome. All right. Well, Zain, this was really, really helpful. I just want to personally thank you. I think Danita said, yesterday was very impactful. Today was even just as impactful. And I will work with the CLA team to see if there are any materials that we can get to these women. But more importantly, Zain, would it be okay for women to reach out who are serious about meeting with you and CLA and want to have a serious consult or conversation? Would it be okay for us to drop in the chat? And I don't know, is Stephanie still on the call? Stephanie McDonald? Probably not. So Keisha, do you mind dropping in the chat the listing for CLA one more time? All right, Tania, you had a question. I apologize. Tania, yes, please ask. Yes. And then Joan.
Thank you. Thank you. So you kind of addressed some things already. So I know based on what you discussed, I'd imagine so I have an art-based business, and evaluating my art business, I know, as you mentioned, a lot of that is going to be based on cash flow or sales, I would assume. But are there any other areas that I should be considering when it comes to evaluating my business outside of just what I'm making with sales of artwork?
Sometimes you got to look at your inventory of artwork, because you may have certain pieces that, for example, if I'm running an art studio in a small town and I have some expensive pieces where there's not a large addressable market for those pieces. So I'll give you an example. It's not a pure analog, but if you build a mansion out in the middle of nowhere, there's not going to be a lot of potential buyers for that. In the art world, sometimes you'll see, like, I have an art studio in an area where there's just not a lot of potential buyers. Could I potentially sell that piece to, say, a studio in New York or Los Angeles, where there's a larger pool of buyers for that particular art piece? You may get more value for what you have in inventory. That's not reflected in your own existing, cash flows. So that's one important thing, like, especially for an art studio or a restaurant, it's just know your addressable market and sell goods and services that make sense to that market. I think that's important to consider.
Does that answer your question, Tania?
Yes. Thank you.
Okay. You're welcome.
Mm-hmm.
And then Joan had a question as well. And by the way, we put CLA's information in the chat, so please at least click on it so y'all can do your thing. Joan, did you have a question?
I did not have a question, but I had a comment. Is that all right?
Sure, absolutely.
So because I'm in the service industry, this may help someone. Thank you, Zain. The material was amazing. I love the last piece of it, the addressable market, because I think in the service-based business, this is where a lot of us fall in the competitive advantage. And I love the whole thing about expanding the growth runway and the elasticity. And I just want to give an example. I am a publisher, so I help people write books and publish books. But if I had stayed in just that niche, I wouldn't be expandable. I wouldn't have an elasticity. So I also offer marketing. And I also offer coaching for people who want to write their books. And I also offer a certification for people who want to become book coaches. So I started to stretch the runway a little bit. I do have a B2B partnership, and I've licensed out my publishing brand to a smaller company. So for anybody who's on the phone or on the call today and you're thinking about how else can I add to what I have, those are some things that you can consider. And last but not least, don't sleep on your email list, because there is value in your email list. So if you have 1,000 people on your email list, you'll never know, you can sell one piece of artwork, Tania, and from somebody on an email list, to just make sure you're continuing to build that list. So I wanted to just add that to the conversation.
That is
No,
so
100%.
That is so perfect. No, I totally agree. And just based on demand, one of the things we're getting ready to do, Joan, is talk about hidden revenue streams, right? And probably bring Zain and the team back. But people have been asking, how do I build a licensing program or a chapter like what we did nationwide? People want the learnings. And so that's coming next as a series for sure. But this was helpful. Zain, thank you to your team. Tomorrow